Welcome to the Old Capital Real Estate Investing Podcast with Michael Becker and Paul Peebles. During this program, you will hear interviews with real-life successful investors who will share their stories and provide useful advice on how to acquire, finance, and operate apartment complexes. Now here they are, Michael Becker and Paul Peebles.
Welcome to the Old Capital Real Estate Investing Podcast. I'm Paul Peebles, National Underwriter at Old Capital. With me today is Michael Becker, Senior Director at Old Capital.
Hey, Paul.
I am excited to have Kenny Wolfe in our spells today. Kenny Wolfe has gone from having zero multifamily to having about 1,200 units in a matter of about 4 years. He tells a fantastic story, and we're really excited to have him in the podcast. So, Mike, people ask us all the time how to put together these types of transactions. One of the things I want to kind of talk about today is non-recourse lending and how do people get non-recourse lending on apartments. So, Mike, can you tell us a little bit about that?
Yeah, really when you're out there trying to, borrow money in commercial real estate, there's two types of loans you can go out there and get. You can get traditional kind of bank type lending, which are recourse loans, which means that you have to sign a personal guarantee on the loan. Or there's non-recourse lending where the real estate kind of stands on its own, and if everything goes bad, you don't have the personal guarantee at risk, and you don't risk your personal assets if everything doesn't go your way. So, really, how do you transition into non-recourse lending is, one of the most important things that we get asked by people that are kind of done a transaction or two and looking to kind of grow and expand the business. So in the apartment space, there's a couple different lenders out there that do non-recourse loans. But the predominant one in our space right now is Fannie Mae, and they do the majority of apartment loans in general, and they certainly are the largest non-recourse lender out there. And to get qualified for a Fannie Mae loan, there's two ways to really do it, and one is to go out, and they don't like loaning to the first timers. They don't want you learning on their nickel. So the way most people do it is they'll go out, they'll buy a smaller property, go to a community bank, a local bank, get a loan, sign personal guarantee on it, and then after a couple years they'll go, sell the deal or go look to buy another deal and, trade up, and at that time they could qualify and be eligible. Or you can do what Kenny did or what I did when I got my first Fannie Mae loan, which is find someone else that had previous multifamily ownership experience, and you join them in the deal and you sign on the note with them as what Fannie Mae calls as a key principal. But the loan is non-recourse, and really one of the biggest aspects or the biggest benefits to having a non-recourse loan is, when you're out there and you're trying to grow and expand in the business and you're going to go sign on a bunch of personal guarantees on a bunch of loans, it kind of what I call clouds your balance sheet. What that means is when you're looking to borrow more and more and more money, the bank's going to look at you and see that you have all these contingent liabilities and potential liabilities. If everything goes bad, it's a drain on your resources, and they're going to be a little bit more nervous about you. Where if you're out there doing non-recourse loans, it doesn't have that effect on your balance sheet, and it frees up your ability to operate and buy more and more and bigger properties as you go. So I think without much further ado, let's start today's interview with Kenny Wolfe, and we'll be on the backside to recap.
So thanks, Mike. Today we have Kenny Wolfe in on the Old Capital podcast, and as everybody knows, we start off at the end, then the beginning, and the end is, Kenny, how many apartment units do you own or manage or control these days?
I'm currently involved in 1,199 units.
Almost 1,200 doors, Kenny?
Yes, 1,200 doors, yeah.
Wow. And when did you get into the apartment business?
We got in almost 4 years ago.
So when you say we got in, that's you and your wife?
Yes, I consider her part of the team.
That's Teresa.
Part of the team.
She is part of the team, no doubt about that. So for everybody who doesn't know Kenny, can you tell us a little bit about yourself, where you're from, and how did you get into the apartment business?
Okay, yeah. I was kind of moved around as a kid, but settled most of the time in Houston. And I spent some time in Colorado, but went to school at Baylor University, and then got into the family business of oil and gas. So I was an oil and gas accountant, and that's kind of where I got started. I got into a small partnership deal up in Shreveport, oil and gas. It was a 5-year contract. Year 3, that contract was winding down. So my wife and I knew we were going to be back in Dallas, and we wanted to make the jump into real estate, so we went right in.
Had you done single-family business before?
No, we decided to skip that step.
So were you familiar with apartments? I mean, how did you make the transition from corporate America to apartments? What piqued your interest?
What got us started was a local real estate group. They had a 2-day seminar, and they talked about, day one was talking about single-family investing, and after the day, my wife and I were all excited. We're going to buy 10 units or 10 houses and that year and all that, so we got excited. Then day two, though, they talked about multifamily investing and how it was just so much better. so we skipped single-family. Single-family seemed to be a lot more work for similar returns, and also multifamily is so much more scalable than single-family.
So you went to the seminar, you got a little bit of information about the multifamily, decided to go to multifamily. Did you get in your first deal that you controlled, or did you become a partner in a transaction?
We decided to go to be a partner in a transaction, be a passive investor. We decided to go that route for a few reasons. We were still living in Shreveport at the time. We wanted to invest in Dallas. That was one. Two was to learn the ropes. Seeing an actual deal is done from the inside is so much more beneficial than reading a book or watching webinars or getting that kind of formal education. But three, it was to build our track record as a multifamily investor, because lenders look at that.
So what year was it that you got a position in a partnership? When did that happen? What year was that?
We closed that deal December 2010.
So what was the name of that property and how many doors?
It was Pioneer Creek Townhomes in Arlington, Texas, and there's 213 units.
So you were one partner out of how many partners?
I believe there's probably about 15 of us.
So 15 partners, everyone put in a couple from $50,000 to $100,000 as investors. And
right.
So you've held that property since 2010. How's that property doing for you?
It's performing really well for us. It's actually on the market right now. So
okay. And now that property, was that a stabilized property that you guys bought, or was that a value-added property?
It was a very much value-add. It was the pizza delivery guys would not go to that property. So we bought it. It was the ugliest one on the block, cleaned it up.
Did that scare you a little bit about, or I guess you guys really didn't know very much that it was that tough at that period of time?
Well, you could tell when you're driving through the property before we bought it. I mean, there were cars on blocks and stuff, but you could see the potential because the other properties around it were nice, you know, for working class.
Well, that was a foreclosure, or somebody owned it and put it into the ground, or?
It was a foreclosure, so the prior owner had bought it and just sucked all the money out, had not reinvested in the property, and just had let it go. So it was pretty rough. So the bank sold it to us directly, and they actually carried the note for us.
So they carried the note, and did they give you money also to rehab the property too?
Some, but most of it we raised to fix up.
Wow. Okay. Well, that's a pretty convenient place where the bank owns the property. They give you the loan to acquire, and then also give you some rehab dollars to fix it up too. So that's kind of a unique situation. Not all transactions are like that way. So, and again, occupancy when you bought it, and then what's their occupancy now?
The occupancy when we bought it, I think, was on paper 50%, but probably half of those were actually paying rent. So when we actually got in there and kicked out people that weren't paying, we probably got down to 25% occupied, and then now it's run between 95 and probably 97% occupied.
And what do you think your all-in price on that deal was, and what do you think, what's it listed for on the market?
We bought it for 2.5. And then we put in about $1.4 million, so our all-in is 3.9 for 213 doors. And then right now it's to be determined by the market on the price.
What do you think the market is going to say?
Our broker said anything from right around the $7 million mark.
Wow. That's going to be a good capital gain. You guys will probably take that money, either split it up and pay the taxes on it, or go into your next investment with an exchange proceeds. So let's kind of walk through. So that was a passive investment, and then a couple months later, you made another passive investment as a partner in which property?
In Rock Island Apartments in Irving, Texas.
And how many doors was that?
It's 154 doors.
And you bought that how many months later after you bought the first one?
Roughly 7 months, 6 months.
And so you were a passive partner in that one. So you were just part of the guys in the back of the boat, throwing money in and letting a managing member manage that property and run the show. And we'll come back to that in a second, too, because we're going to talk a little bit about some of the challenges are when you're a passive investor. So the next one you bought, you decided to jump from sitting behind the pilot to becoming the captain of the plane.
Right.
Deal number 3 for you was which property?
Was Lakeside Village in Wiley, Texas.
Okay.
It's got 76 doors.
All right. How did you find that property? And tell me a little bit about that one.
Through our broker, through my contact of a broker, they said it was on the market, or it wasn't quite on the market yet, but they were about to bring it to market, so we had a first crack at it.
So 76 doors. You signed as a KP, which stands for key principal. That's somebody that is going to be the person that the lender is going to focus in on, is managing the partnership, managing the property. They're the eyes and ears for the borrower. Now, the borrower may have a different name because that's the entity, but they're the actual person that stands behind the entity. So you did that loan through Fannie Mae?
Yeah, Fannie Mae.
And so what was the benefits you saw to having a Fannie Mae loan?
The first and foremost was the non-recourse
Okay.
aspect of it. Second was it was 80% loan to cost, and the rate was relatively low.
So by being in two previous transactions, the Pioneer Creek and the Rock Island, you were in a position in the eyes of Fannie Mae to then now sponsor or be a key principal in the deal that you could run yourself.
Right, and I think it helped that Rock Island, the second passive deal we did, was a Fannie Mae loan.
Okay. And so you did that in September of 2012. 76 doors, that was a stabilized property because Fannie Mae wants to see stabilized assets. Then almost a year later, you purchased a property up in Denton, which is a suburb of Dallas, kind of a 55,000 in population or so of students. Is that a student property up there, a property called Village East?
We're getting some, but we kind of focused on keeping the working class aspect to that property because the name of the game in Denton was to buy these working class properties, put a whole bunch of money into them, and then pitch them to the students. And so that meant all the working class in Denton, Texas were getting compressed into very few properties.
So this property was for the people that supported the university, worked in the Starbucks or the Tom Thumbs, in the grocery stores in the area, or supported the university. But some of them went to school, but a lot of them were not active students at school. But this property, you did as a Fannie Mae loan, but one of the benefits is the longer you can work with Fannie Mae is that they offered you rehab dollars on that property. And tell us a little bit about what did you buy that property for and how much rehab dollars did you get?
We bought it for $4.3 million for 133 units. And then we got another $600,000 in rehab dollars from Fannie Mae.
And where did that money go into?
We did everything from foundation work to sewer line breaks to painting, all the pretty stuff. Painting, we've upgraded half the units to new flooring, new appliances, things like that.
So Fannie Mae didn't tell you what to put the money into. You kind of told Fannie Mae what you wanted to put the money into, and they gave you the thumbs up or the thumbs down, and then they cut you checks for the proceeds of the rehab dollars. Is that right?
Right, yeah. And I've been very impressed at how quickly they reimburse us for those rehab costs. It's a matter of days. So
you're not managing the property, or you're not managing any of these properties. Is that correct?
Not myself.
You have a third-party management company. So your role in these four properties, two you're in the back of the bus or so, and then two you're in the captain's chair, but you're not physically day-to-day on the property overseeing the management company. You have a third-party management company, and you're the person that's kind of overseeing as the asset manager. How much time do you usually go into some of these properties and see how things are running?
I go in, it depends on the property. If the property's doing well and performing like it's supposed to, I don't go as often because the numbers are fine, but I'll probably spend about 2 hours a week maybe on each property. And that doesn't mean physically on site, but working on it.
Right. And so the more properties you do that have success, the more opportunities you may have with fellow investors that want you to help them be successful too. Because if you have a track record, they see that, Fannie Mae sees that, then you can help other investors buy properties. But a property called Chancellor, which you bought in January of 2014, just the beginning of this year, you took the role as a passive. You saw an opportunity in that property. That's 224 doors. And how did that work out?
I was brought in to help as part of the management team to kind of help form the partnership and get the deal closed. And so that's how my track record with raising funds and also with lenders helped get me into that deal.
And the same thing happened with Oaks at Jane Lane. You were kind of brought in to help another key principal who wasn't as strong as you with the track record acquire a property over in Haltom City, a property called Oaks at Jane Lane, which was 109 doors. It was a stabilized property, is that right?
Right. Yeah. It was very stabilized. It was very much a yield play, cash cow for us.
So you bought that just at the beginning of summer, May of 2014. And so the structure of that deal was, if I remember, is that it was you, another KP, another KP, another KP. So you guys had like 5 key principals on the deal.
Right.
So it's almost like being part of a country club. Is that to get that Fannie Mae license or country club card, you have to kind of sponsor other people. So what you've been doing is pretty much sponsoring other people to get their Fannie Mae country club card. Am I kind of characterizing that correctly?
Yeah, and it's kind of worked both ways. So on deals that I've closed myself that I run, I always bring on KP or guys or girls that want to be future buyers and want to get the Fannie Mae card. I bring them on as KPs.
Because you couldn't do it if you didn't have a track record of ownership or management of an apartment complex. Fannie Mae does not want to be your training wheels. They want to make sure that you train on other transactions before it goes to a non-recourse deal with them. They would want you to learn with, say, a small regional bank financing on an apartment complex for a couple of years. That's going to be a recourse loan. These properties fall apart really because of 2 reasons. One is not enough cash that's put into the property to rehab them. And the second one is management. And so you have to learn how to manage at an upper level, not just day-to-day manage, but be an asset manager to find out what's right for the property. So the longer the track record you have, the more comfortable that Fannie Mae has with you. So your last transaction you did, and I say last, I mean, it was just a month or 2 ago, is a property called Cheyenne Vista. This property wasn't in Texas, but it was where?
It was in Colorado Springs.
And how the heck did you guys find a property up in Colorado Springs?
So I was looking to get outside of Texas and grow outside the state. And so what I did was, to do that, you have to have a trusted third-party management company that's on the ground. And so the management company that handled our property in Denton for us, their headquarters was in Denver. And so I knew I wanted to eventually possibly go to Colorado. So that was very easy for me to jump up there to Colorado Springs and have them manage the property up there while I'm here in Dallas.
No kidding. Let's go back to that one just for a second. What were some of the, I would say, funny things that you learned about owning a property in Colorado Springs or in the state of Colorado?
I believe you're referring to the new marijuana laws there in Colorado. So
yes, I am.
On our due diligence, we found a few, people had their paraphernalia out, and also a few of them had grow rooms where they're legally allowed to grow marijuana. I think it's up to 6 plants per resident. So
holy cow!
Yeah, it was very eye opening.
No kidding. So as an apartment owner, to get higher rents, could you turn the whole property into a pot farm on every door?
I guess we could. There was a lot of jokes about doing as a community amenity, doing a garden room. On walking the property, there were 2 units of the 190 that had grow rooms, and they were the most clean units I've ever seen. And so the residents would live in 1 bedroom. It was a 2-bedroom apartment. The pot had the whole nother bedroom to itself.
That's a funny story. So you did a Fannie Mae loan on that transaction. You were a key principal on that transaction. 190 doors. What did that sell for?
We bought it for $10.8 million.
Wow. So $10.8 million. You did, 80% leverage on that?
Yep, 80%. And then also 80% of the rehab dollars as well.
And how much in rehab did you guys put in that deal?
We've got $925,000.
And what's that going to be used for?
Luckily on this property, it's not a lot of foundation. It's all the pretty stuff that residents will pay more in rent for. So it's new fencing. They had a whole bunch of chain link fence, so we took that down, put up wrought iron. We spruced up the pool area. We're doing upgraded units on about 40% of the units. New flooring, tile backsplash, new appliances. We're just now getting into the exterior stuff, which we're going to do. So the siding and all that on the property. We've redone the playground area. We spruced up the dog part of it. So,
no kidding. So, looking at the number of transactions that you've closed and the number of properties that you own, and you're an asset manager on, so you have 591 doors that you're a passive investor on, that you're letting somebody else manage the asset, that you're getting, I guess, residual income or income based on the amount of money you put in, maybe pari passu on that one. and as a KP, you're a managing member of 608 doors for a total of almost 1,200 doors. Now, you got into this business less than 4 years ago. How old are you, Kenny?
I'm 33 years old.
So 33 years old, and you have 1,200 doors. That's a kind of an amazing story. Now, for people who are not in the apartment business that want to get into the business, it's just like, there's a lot of show and show business, but it really is a business. In an apartment business, it is a business. Whether it's a Subway sandwich shop or it is a taco stand, you have to stay on top of the property all the time, or people are going to steal from you. Your best ideas, and for people who have never been in the business, tell us, some of the good things about being in the apartment business and some of the bad things, what things that people should be aware of.
The good things is that it's so scalable, and you can maximize your time. I mean, I don't get phone calls from tenants about their toilets or, whatever's going on in the day-to-day stuff. That's handled for us. That's the good part, is that it's so scalable, and there's really no limit to what how big you can grow your business. The downside, I mean, there is sometimes when we don't hit our budget numbers for some reason, or there's a insurance claim that we got to work through, or those kind of things are the things that happen in any business, and you have to address them. But luckily for us, they're pretty far and few between.
So you had kind of an odd situation happen with you on one of your properties, that you were a kind of a passive partner in one of them, and that the managing member of that property kind of went off the map, and the heads of the partnership said, "Hey, listen, Kenny, we see your track record. We like what you've done. Can you help us go from a passive position to kind of a managing member?" And how did that work out for you?
It's gone really well for us. We were able to turn it around. It was down to 76% occupancy, which in that submarket should be at 97%. And so there was obviously some management issues we had to address. There was an ongoing insurance claim. So there's a lot of things going on with that property. Now we've got that up to about 90% pre-leased units. It's cash flowing again.
So in a stabilized marketplace, at least where we're located at, it should be 90 or 95% occupancy. That property was in the 70s. Managing member, I think, got a little bit over their head, and the guarantors or key principals in the transaction recognized that. They made an economic decision that they wanted to say goodbye to one person and then bring somebody who had a track record in. I would say the kind of the fixer, and kind of fixed the situation, righted the boat, stabilized the property again. And now, because it is a stabilized property and it was done through Fannie Mae, you're able to generate income and keep the asset going. So it was a good property. It stumbled a little bit, and now it's back on its feet. Is that a fair thing to say?
Yes. Yeah.
And they, in fact, with another transaction that's not even on our board here, is one that you had no ownership interest in, I believe. And that property had another management issue too. And the godfathers of the entity that owned the property, they asked you to come in and kind of fix that one too. So once you get known in the apartment business that you can fix other people's properties and problems, that gets you more exposure, that you can get into positions of future ownership on these properties too.
Right, yeah, and it also looks good to Fannie Mae too. I mean, that Rock Island deal was a Fannie Mae deal, and so I was approached not only by the key principals in that property, but also Fannie Mae asked me to step up too. So
that's good. So future, what's the future lie for Kenny and Teresa?
We're continuing to looking in Texas and Colorado. We're toying with getting into some other submarkets as well. So I mean, it's right now we'd like to grow a portfolio and for the next 2-3 years and then see where it goes.
Good. Again, anything else that you'd want to add, that if the person listening to this was you 4 years ago, any good information or advice that you'd have?
I mean, as I'm sitting here and 3.5-4 years ago, I would have laughed at you if you told me I'd be sitting here today with almost 1,200 units tied to my name. But it's just a matter of getting started and networking. I mean, it's a people business, and that's something else I like about it, that there's less people you have to know in multifamily than in single family. So once you get into that club and you're proven, and it just takes off. So the big thing is get started.
And meeting people. You went to an investment club, that helped you. And then once you got a track record that the listing agents saw that you were able to close on time at almost full sales price, now deals come to you. So you don't really have to go searching out deals too much. I mean, you're still a hunter looking for the right deal, but I'm sure people are knocking on your door almost every day saying, listen, buy this from me.
Right, yeah. My email box stays pretty full of potential buys. So,
well, good. Kenny, I appreciate your time today. Again, Kenny Wolfe is located in Dallas, and if there's any questions, what's your email address, Kenny?
Kenny, Kenny, at Wolfe, WOLFE-RE.com.
Kenny Wolfe, thanks for your time. Appreciate it.
Thanks, Paul.
Hey, thanks, Paul. Kenny's really got a great story. I thought that was a great interview, and really learned a lot from Kenny.
Yeah, Kenny and Teresa are great people. Taking it from 0 to almost 1,200 units within 4 years is a pretty remarkable story.
When I think of Kenny, knowing him a little bit, I mean, Kenny's a pretty network guy within his little circle of people. And Kenny's now kind of turned into 3 or 4 years in this business now. The guy, when other people are having a problem getting a deal done, getting the experience, getting the non-recourse debt, they seek Kenny out to join part of their group. He's really been able to capitalize on that and do more and more deals along the way. So I really appreciate everyone listening to today's Old Capital Real Estate Investing Podcast. If you want to find out more information about us, please go to oldcapitallending.com. Also, if you guys would please go to iTunes and give us a good review, that really helps us move up the rankings and really get our podcast exposed to more and more people. Thank you, and we'll see you guys here next week with another great interview.
Thank you for listening to the Old Capital Real Estate Investing Podcast. Please join us at oldcapitallending.com to sign up for our weekly email updates. We'll see you here next week with another great interview.